Hello, everybody. Good morning to us all. This is Olga Shannon. My name is Cindy. Today we are going to learn about options. Okay, so I've realized that that topic is quite confusing for some of us. So I just want to try my best and then help other people. Okay, all to the glory of God. So today we're going to talk about options. But our focus will be on one aspect of the option. And another time we do another aspect of the option. Okay. Yeah. So today we're going to look at core option, which is one aspect of what option. So basically when we talk about option, what do we mean by options? So options are also kind of like derivatives, okay? So let me start the whole picture from what derivatives are. So derivatives are assets, okay, or they are financial instruments that derive their value from an underlying what asset. So, for instance, if let's say we have you and then maybe somebody are standing there, right? And let's say you are the main asset. So for instance, it can be a stock, can be a bond, name and or and other assets. And then the other person is the derivative whose value is being derived from your value. Whose value is being derived from your value. All right. So for instance, if let's say the stock, which is you, increases, then the other person who is imitating you or who is following you will also have its value what changing. But the changes can depend on so many factors, right? So whether it can either the other person or the other value can go up, can go down, right? Depending on what you, the main stock, is what is experienced and on the market. Okay. So derivative, they are just assets. They are like financial instruments that people leverage on in order to mitigate certain risks. Okay. So they try to use it for speculations. So for instance, if I know that the main stock will increase maybe today or tomorrow, I might try to use my derivative to make a projection and then make profit from it. All right. So derivatives are just assets or financial instruments that derive their what value from an underlying what asset. Okay. They derive their value from an underlying asset. So um so we want to understand an aspect of derivative. So derivative, they have different forms. We have the futures, we have the forwards, we have the options, and then the swaps. Okay, and I'm sure we have so many other derivatives out there. Okay, yeah. So, but we want to focus on options. Okay, for the futures and the forwards, they are kind of straightforward. All right, there are some more straightforward. Okay, but then we want to look at options, right? Because they are quite they are quite confusing, right? So we talk about option. What are options? So even in layman's term, let me say an option. It means I can either do this or do that, or refuse not to do it at all. So when maybe let's say you want to even get married, right? You can either choose this person, that person, or even decide not to even get married at all. It's an option. So in derivative to options give the holders what's the right to either buy or sell at a particular price. Okay. So all of this derivative that we are talking about, it's kind of like you're making a speculation that something, the main assets, which are the stocks, the bonds, etc., they will change or they will do this. So you want to secure yourself in the future. So derivatives are usually used to hedge against risk. Okay. So if for instance you decide that okay, I think the price of the stock will fall in the future, right? Maybe you want to buy in the future. right? You agree on a price today with someone, and then you say that, okay, if the price falls, you still sell it to me at this price that we are entering, right? So that's like derivative. So we have something called the strike price, or it can also be named as the exercise price. So that's the price at which the two parties involved in the derivative contract agree on at a future date. So they agree on the price today, which they will leverage on, or which they will be using in the future. All right. So that's mostly what derivative are. Like you are trying to hedge against risk. Okay, so that if you know that you might lose in the future, let me enter into a contract with someone who is willing to take up certain risk. Okay, right. So we know that sometime in the future things can change. Though you made your predictions, your speculations, and all that, but definitely things can change. Okay, so if things change, what would you do? All right, what would you do? All right, so that's what we want to do. But we want to understand the option part of the derivative. So that's today's main goal. Okay, so options, like I said, they are assets, or they are a form of derivative, or is a type of financial instrument that gives the holders the right to either buy, sell, or hold goods, their assets, right? So we give them the right to either buy or sell a particular asset, right, at a particular date, at a particular price. So it's like it's a specific asset you are dealing with, and then it has a particular price that you are entering into today, and then you have a particular date that you'll be ending the contract. So we have the strike price, which is the price you are entering into today. We have the asset, the specific asset you are doing. It can be a stock, can be bond. So someone say that I've entered into a stock option. What is my stock option? So it has a specific asset, then at a specific time. So we can be that the contract will expire in a year, 2 years, 3 months. So it depends on what the parties have agreed on. Right. So let's go to our slides. I made it simple, okay, so that this will help us. So understanding call and put options. All right, so an introduction to options trading. An introduction to options trading. Okay, so now look at, as I said, definition of options. So options, they are financial instruments, right, that give that provides the rights but not the obligation. So you have a right, an option. I can either do it or it's a choice. So for us, I've agreed or entered into the contract, doesn't obligate me or put a burden on me to exercise it if I don't have money in the future, or if things doesn't go my way, they get it. So they are financial instruments that provide the right but not the obligation to either buy or sell an asset at a specified price before a certain date or even at a certain date. All right. So that's what an option is. So we have types of options, right? So we have the call options, and then we have the put options. That's what we're going to look at. These are the two major types of options. I don't know if the other time that they are coming up, but this is what we are focusing on, right? So we have two types of options. We have the call option and we have the put option. Okay, call option and the put option. So let's look at some things, right? So each type of option can be in the following forms, either long or short. So this long short issues what brings about all this confusions and all that. Okay, so we can have the options, either of them having a form of the long or the short, right? So we can have like long call, short call, long put, short put. So that's what the statement means. So each option can either be in the form of a long or a short. So what does long and short, or what do they mean? Okay, so long position relates to the party that has agreed to buy. So we want to see that, okay, so if, let's say, I've decided to buy the call option or the put option, it means my position, I'm in the long position. So it's like long means you are looking to put, like, let's make this assumption. Long means that you are waiting for the price or whatever of the assets, the price of the assets, whether bond, stocks, as the assets you are trying to buy in the future. If the price increases, right? So your position is you would make profit if the price increases, right? If the price of the stock increases, you make profit. So it's like you are looking at the long side of it. Let's take it that way. Then the short position relates to the party that has agreed to sell, right? So if, let's say, you are trying to sell something to somebody, imagine if, let's say, if the prices are increasing in the market, will come there, it will affect you, but your position is short such that you make profits when the prices are falling. So let's make this assumption. So if prices are going up, so like long, if they are coming down short, so if they are going up, it will benefit the buyer, right? And if they are coming down, to benefit the seller. So that means long position relates the party that has agreed to buy, and short position relates the party that has agreed to sell. So the long buyer, you are looking at potential increase in the future. So long, so like it's going up. So that's the position of the buyer. And short, if the price is going down, you are in the selling position, or you are the seller. Okay, we'll see that shortly. So what's call option, right? So definition. A call option gives the holder the right to buy an asset at a specified price within a specific time period. So put in here, call option is the right to buy an asset. It gives you the right to buy an asset. So if I'm holding a call option, it means that the party I entered into, the other party whom I entered a contract with, right? The person is I'm going to buy from the person. So I'm holding a call option. So it's giving me the right to buy the assets from the person in the future based on the price you've agreed on. So that's a call option. Call. Like, so if you say you are holding the option and then you want to buy, you call the person and then you buy. That kind of analogy. Okay, so call option gives the holder the right. So you have the right to buy although you can refuse not to buy, right? You can buy or refuse not to buy. So we are buying the assets from the other person. That is what the call option. But buying the assets from the other person, not from the market, from the other person that you've entered the contract into at a specific price. And that specified price is the strike price we are entering into today. So key terms, strike price. So the price at which the holder can buy the assets. So if two parties entered into a contract and then they agree that in the future, this is the price we'll be working with, whether selling or buying. So we'll be working with 5 cedis. Okay. So we're working with we'll be working with 5 cedis, all right? So that's the strike price. So if I'm buying from, so let's say Akosia and Ama has entered into a contract. Akosia and Ama has entered into a contract, okay? And then they agree that in the future, the assets, underlying assets will be traded between them by 5 cedi or at the price of 5 cedi. So if Ajwa is the one holding the call option, it means Ajwa is going to buy the assets from Kofi's hands at 5 cedis. So that's the call option. If it is Kofi that is holding the option, it means that Kofi is the one going to buy the asset from Ajwa at the 5 cedis. Okay, so it's like buying, so we are taking it from the other person, not going to the market, but from the other person. The expiration date is the date by which the option must be exercised. So if, let's say, the option will be exercised by Friday or in 3 months or a year, that's the expiration date. So at that date, we are no more in a contract. So like normal contract where we have an end date, and then at the end of the day, the contract is annulled because we are done with it. And the premium is the cost of purchasing the option. You know that there's no way, even if you're taking up risk from someone, right? You're going to pay something. Because since it's an option to it's an option. It's an option that it gives you the right to either buy or sell. It means that the other party will be in a particular position, like will be at risk if you choose not to buy again. So you have to compensate me even before that happens. Do you get it? So that if you don't buy from me again, I will not be at loss, like a total loss, because I'll be putting my trust in you that I'm buying from you. And at the end of the day, say, no, I can't buy from you again. To get it. So the premium is the cost that the person is paying, or the other way around is if the person is taking the risk to sell to you at a lower price, what if the price increase in the future? The person will be at loss. So the premium is kind of like a compensation to either parties, okay, whether the one on the buying side or the one on the selling side. So that if anything happens in the future, it doesn't go their way, they'll kind of have some little compensation for the risks they've taken onto themselves. Okay. So long call position, like I said, we have a long call and then we have a short call. Okay. So long call means that we are looking at it from the buyer's perspective. So like you've entered into a contract, which is called call option. Okay. You've entered into a contract called call option. So the call option is the assumption that you're coming to buy the assets. So two parties are inside. So the one who is coming to buy the assets, right, is the one having the long position. So that's why we call it the long call, which is looking at the buyer side. The one who is going to sell it to the buyer is holding the short position, but the transaction is in a call option. Transaction is about a call option, which is right to buy the assets. Do you get it? So we take it from the buyer's perspective. So the buyer will have a long position, and the one from whom the person is buying will have the short position. So long call position, you're buying a call option because you believe the asset price will rise. That's why I say that the how should I put it? The transaction is about call, and call means the right to buy. So the thing is, we are buying the assets from the person that we are in the contract with. But in the contract, we want to see what position do both parties hold in the call option. Is it that one will make profits, one will make loss when this and this happens? So when you look at the long position, that means you're looking at the buyer position. The person is buying the assets or is buying the call option because he believes the asset price will rise in the future. So the assets is the underlying assets, right? Like we spoke earlier. So if it's a stock, you know that, okay, so you are thinking that the stock price will increase in the future. So let me secure myself today with this thing called option. That is, with this contract and we've entered into with somebody. So the buyer's point of view is that he believes the asset price will rise. So he's entering into this call option to be able to, so that he will not pay more to buy in the market. Okay. That he will not pay more to buy in the market. So let's do two things here with this long call and all that. So we have the derivative market, and then we have the asset market. So the derivative market is where the person is going to enter into that call option. All right. And then aiming that the price of the asset itself in the real market will increase. Okay. So the trade that they are doing is about an asset that they are looking out to buy or sell in the future. So the long call is to buy the assets. Okay. So AMA has the stock. No, let me say it like this. AMA doesn't have the stock. So Amma and Kofi have sat down and they are like, let me say that Kofi has sat down. So we are looking at the long call. Kofi has sat down. It's like, I think that the MTN stock will rise to 6 cedi in the future. Maybe in 3 years' time, okay, it will rise like 6 cedis. So if, let's say, I'm waiting for the future and the future comes and indeed the 6 cedis, it means that I'm buying from the market at 6 cedis. Right? If I'm buying it at 6 cedis and I'm going to sell it at 6. So like I was saying earlier, sorry, the network. Okay. So I was saying, so if it's going to buy 6 cities, right? So it means that, okay, if I don't enter into a contract with anybody, and then in the future, I realize that, so in the future, I realize that the price is going to increase to 6 cities. So it means in 2 years, I'm going to buy MTN shares for 6 cities. It should be quite expensive for me. So I'll be like, okay, let me go and look for Kojo Man, right? Who is ready, who is willing to take up risk. I went to look for Kojo. I was like, Kojo, can we enter into a contract? Okay. So I want to ask to enter into a contract. Let's write. So I'll be buying stock from you. Okay. So it's like Kojo is also a trader. I'm also a trader. And I've speculated that in the future MTN price right 6. That I want to make profit. I don't want to make loss because if I go and buy it at 6 from the market, I'll still sell it at 6. So Kofi and me, myself, we enter into a contract, we sit down, then we write. So I want to buy an asset. Okay, which assets? Maybe MTN stock. Okay, MTN stock. So now we're using like 1 unit, just one. If you want to buy 10, just multiplication stuff. So let's say I buy one of MTN. So, okay, in the future, MTN, we want to buy one, okay? So I want to buy it from you at 3 cities. Okay, so you want to buy it from me at 3 cities. Do you agree? Okay, so before Kojo will say, okay, he has also speculated that MTN cannot rise to 6. So it will rather reduce to 3. I think 3 is fine. So they write 3. And then they write the dates in 3 years' time. Right. So they've written it down. So it's not like Kojo Menu is holding the stock at that time. No, 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 no. So it means that if the 3 years time comes, okay, and then MTN price is 6 cities now, right? So me, Cindy, I've come to Kojo. So I'm looking at the call, right, to buy. Come to Kojo, that Kojo, I'm now coming to buy the assets. I told you that the price, let's agree at 3 cities. So Kojo will now have to go to the stock market and go and buy that one share from MTN at 6 cities. And then come to me and I'll buy it from him at 3 cities. Do you get it? It's not like when they are entering a contract at the first time, they are all holding the asset or no. They are making speculations. Okay. So the option is buying. So like I'm buying, so it's about buying the asset. So I'm coming to buy. So I'm coming to profit. And then I'm in the wrong position because I'm speculating that MTN price will increase to 6 cities. All right. And then I come to Kofi and then we enter into the contract and then he write 3 cities in the contract, we sign everything. So when that 3 years come, and indeed my MTN price increases to 6 cities, I will go to Kofi. Because I don't want to go and buy from the market 6 cities and make loss. Nah. I'll go to Kofi that Kofi. So down there, I want to buy the assets from you. I agreed at 3 cities. So Kofi will now have to go to the market and buy the assets at 6 cities and come and sell to you at 3 cities. And then you will buy it from him at 3 cities. You get it? Yes, so you buy it from him at what, the 3 cities, not the 6 cities. So you know, like at the first start of the conversation, they are holding stocks. No, it's at the end of the period that they've agreed when the prices rise or increase, whatever. Then that's when they are going to buy from the market and then so on and all that. Okay. So the long call position, the buyer believes that the price will rise. So I believe that the price will rise. So I'm buying the call option. That gives me the right to buy it from the person, from the other person, and not going to the market straight. So when we enter the contract, I could have gone to the market straight to buy it at 6 cities, but I'll make loss. So I'm buying the assets from Kofi's hands at 3 cities. But he has to go and look for it and bring it to me and sell it to me at 3 cities. Then when I take it from him at 3 cities, I'll go and sell it in the market for somebody else, a normal investor at the 6 cities and make profits. I hope it's clear. And make profit. So I'm going to sell it at the market at 6 cities and make profit. All right, so I hope that is fair enough. Okay. So let's move on to an example. Okay, I've said a lot, but then let's look at an example. So a scenario that we have here, that you buy a call option for stock A, right? So with a strike price of 50, expiring in 3 months for a premium of 5 cedis. So let's break this down. So I'm buying a call option for stock A. So like I said, we've written the contracts down. So like the options are like contracts. We've written the contracts down. All right. So we've written contract one. That's myself and yourself. Let me do that. Myself and yourself. You're entering into it. You've written the contract down that we're buying MTN share. All right. So sorry, my network is speaking. All right. So let's look at our example again. All right. So we are buying a call option for stock A. So let's say the stock A is empty. So myself and yourself entered into a contract. The contract is a call option. And I'm having the long position. That means I am buying the option. Okay. So I am buying the option, and I'll only come and buy the option if I anticipate that the price of MTN will increase in the future at 6. So I'm buying the call option, which is the contract, which has a strike price. So let's use this 50 cedis. So let's say I'm anticipating that the price will increase, the price of MTN shares will increase to 100 in the future. I don't want to spend big money like this and go and buy one share. So I'm like, okay, there's something called a derivative market, and there's also something called option, where I can either do it or not based on whether my speculations are right or not. So fine, if that's the case, let me go and buy something like this so that I can secure and then not risk myself. So I go to the derivative market, I go for a call option that gives me the right to buy from the other party in the contract. So in that contract that I took, they've written that the price that will be transacting at and the expiring date is 50. Like, oh really? That's good, because I'm anticipating 100 for one share in 3 months. So if they say 50, it means I can make some profit. So let me take this contract, right? But then there's a premium of 5 cedi, because don't forget, if you take this contract, the other party who is involved he might be at risk. Because what if your speculation comes to pass? I mean, the person will lose everything. No, it shouldn't be so, right? So we are looking from the perspective of the buyer of the call option. That's why it's called long, because the person is anticipating a rise in the price of the asset in the future. So he's coming to buy, secure himself now with something called call option, which is just a contract there, right? So fine, taking, so let's see what happens after that. So step one, you pay your the premium of 5 cedis, $5. Let's say it's $5 upfront. So take this $5. So I'm buying just one share. If it is 10 shares you are buying, right? You pay 5 times 10 is 50. So like $5 is for just one. So it's like per unit, but we are looking at just one share, not to confuse ourselves. So if it is 10 shares, 5 times 10, that's what you are paying upfront. So you pay your 5 premium to the person that buy one share, and the person will take it. So let's see. So why? So this is the cost of buying the option. It is paid upfront, like I said. That's the cost of buying the option, of entering into that contract. So the other person, the other party, or you, if I'm the one buying from you, you will be a little secure if anything happens. Because the reason why you chose that option, that's the rights. The reason why you accepted that I'll have the right to buy from you is you are thinking the price will go to 20, not 100, as in my head. Okay, so we all have different calculations in our head. So you are thinking the price will fall, okay, and then I'm thinking that the price will rise. So like we all have different position. That's why the buyer side is having the long position because he's thinking that the price will rise to make profit. Step two, if the stock A's price rise to 60, exercise the option. Why? So let's see this. So I said that I was speculating that the price will rise to will increase. So now let's see, we are using the 60, not the 100. Okay, so the price is 60. Wow, it means that I've secured myself in this risk. So I'll go to you. I'll be like, so we entered into this contract and it gives me the right to exercise. So it means that I'm buying from you at what? 50. So you are going to buy it from them. So like I said earlier, you don't have the stock. You're just entering into a contract, and whatever happens at the expiration date, whether I exercise or not, will determine what happens. So if I decide to exercise because the price in the market is 60, I'm not going to buy it 60 straight from the market. No, I come to you that you said you sell it, you give it to, I can buy from you at 50. So you go and get it from me, wherever you get it from me. Then at the 60 price, you come there and you get wherever you get it, come and sell it to me at 50. So I'll take that one MTN share from you at 50, so I'll pay you 50. Then I will go to the markets and go and sell it at 60. Then I'll make my profits. That's what the call option is. How do we make profits? Not net profit, like profit, general profit just from the price. So I will take it from you at the 50, then I'm going to sell it at 60 in the market. It means I'm going to make profits. You get it? So you are going to buy it and give it to me at 50, and I'm going to sell it and make profits. So I have the right, when I exercise the option, means that I'm accepting the contract. I mean that I'm letting the contract code. You get it? So explanation for that. You choose to use your right to buy stock A at 50 from the other party because now the price in the market is higher. So when you buy it from me at 50, you can go and sell it in the market at 60 and then make a gross gain. Get it? So now I want to look at, don't forget that you pay the premium upfront, and that's the money you pay with your money. So that's going to be your cost, the cost you incurred, right? The cost that you incurred. So that's the premium cost, that's the initial cost. So you buy the stock at 50. So your total cost will be 55. Because you are paying the person the 50 for the stock he's bringing you, and then you are going to sell it. So when you pay, any money you take out of your pocket is your cost. So you took out the premium at first, which was 5. Then now you are taking, since you are exercising the option, you are accepting to use your rights and say that, yes, I'm buying from you. You pay the person 50. So the total cost will be 55. So the explanation that your effective cost per share is the strike price plus the premium paid. That's the effective cost per share. Then step 4, you sell the stock A at 60. So now that you bought it from me, now that I bought it from you, so I'm the buyer, sorry, I bought it from you at 50. Now I'll go to the market and look for an ordinary investor and sell it to the person at 60. Because that's the person is dealing in the normal market. I came from a derivative market, and then I'm coming to a normal market. Sell to someone who doesn't know, first will buy it at 60, right? So you sell it at 60. I'll sell it at 60. No issue, because you gave it to me at 50. So now I have that one MTN share and I go to the market and sell it at 60 just to make profit. So you sell the stock at the current market price. So now your profits, that's your net profits, will be your 60 minus your 55. So you made a profit of 5 per share, 5 cedis per share. So the 60 is the price you sold it. So that's your selling price. And your cost price is what we saw at step 3. And then your profit per share will be 5 cedis or $5 to get. So you make $5 out of it. You get. So that's a long call position. A long call position. So you're looking from the buyer side. The option itself gives the right to buy. So it means that if I choose and buying, the other person has no choice than to give it to me. He can't say no because the option is a buyer's option. It's a call option. So it gives one party the right to buy. So if let's say right now the price increased to 16, I was like, yes, I want to buy. The other person cannot say no because I have the right to buy because it's a call option. You get to the other person cannot say no. If you get it. So let's look at another example. Okay, so let's say the explanation. So the difference between selling price and then your total cost is your profit. So another example for the long call. So buy a call option on gold with a strike price of $1,800 per ounce or ounce. How you pronounce it depends on your diction. So let's say 1 gold unit you get, the strike price is 1,800, expiring in 2 months for a premium of $50. Okay, for a premium of $50. So the call option, don't forget, I know I'm insisting on that because we have another option. So the call option gives the right to buy. So if I decide that yes, I'm buying from you, you have no choice but to give it to me because I have the right to buy from you. You get it? But I can decide not to buy from you if things don't go my way because it's called an auction. You get it? Okay. So we buy a call option on gold with a strike price of $1,800 for a unit of the gold, expiring in 2 months for a premium of 50. All right, for a premium of 50. Okay, so for a premium of 50, sorry. So let's look at these things here. So the strike price, like I said, when you went to take that contract of call option that has been written there, when you open the contract, it's written that the price will be transacting at 2 months' time is 1,800. And then you think, oh, okay, so for every share, 1,800. Let me see. Will gold increase or for? I think gold will increase to say 2,000. If yes, then if I take this contract and then I buy it from someone at 1,008, I can make some profit. So the person, okay, let me take this option. Let me take this contract. Let me take this contract, okay. And then, but then you're taking the contract, the other person too is taking a risk. What if, because before he's accepting to be in this contract with you, because if you decide to exercise your rights, he has no option but to give it to you because you have the right, not him. You, the buyer, have this right, okay. You're looking at long call. You, the buyer, have this right. You the call gives you the right to either how should I put it? Sell, either buy from the person or not. Okay. So if let's say you decide that the price is 2,000, let me take this contract, fine. We have to pay the person for the risk he's taking. So you give the person $15 as premium, pay upfront. So you pay the $50, which is the premium. This is the cost of purchasing the option. Right. So like compensation for that risk that the other person is entering into. So the cost of purchasing the option, you go to the derivative market, just like you go to a normal market to buy something. The derivative market, the contract has been written. When you take it, you pay for it. Though that is not the asset itself. But you just, because it's a risk someone also taking, you have to compensate the person. Just like you go to the market and want to buy tomatoes. You pay the person for going to get you the item at your convenience. So this one to you buy the option, you pay to compensate the person for taking up this risk in the future, which you don't even know what will happen. Step 2, if the gold rises to 1,900, exercise the option. Because now the price of the gold in the gold market, not in the derivative market, derivative or the option is there deriving the value from the gold, but not the person doesn't have the gold itself yet. So in the gold market, the price increased to 1,900. Instead of me going to the gold market to buy my money 1,900, I just come to you that, hey, Kofi, since I have the right to buy from you, right? I want to buy it from you at 1,800. And since he has the right, he's exercising it. So you have to go and look for the gold for me and sell it to me. I don't know the price you get it. I mean, I don't care. Don't look for it. You can give it to me at 1,800, right? And then me, I'll go to the market, the gold market itself, and go and pay and sell it at 1,900 for my gain. That one you are not there. You get it. So you buy the gold at 1,800 from the person. So what will be your total cost? Don't forget to pay 50 when you are purchasing the option, the contract. Now you are going to pay the person 1,800 to buy the one gold from the person. Will be the strike price plus your premium give you a total cost. Then raise your effective cost per ounce, which is the strike price plus the premium. Tongue twister, strike price plus the premium. Then for you sell the gold in the market. So you sell the gold at the market price. So in the gold market, we sell it at 1,900 because that's the price working in the market. So you go and sell it and you get 1,900. Profit calculation is your 1,900 minus your 1,850, which is the total cost in step 3, and then you make a profit of 50. So these are just assumption prices, okay? So anything can happen. So when you realize that the price, so now we are saying that in step 2, we said if the gold price rises to 1,900, exercise the option. So it means if it doesn't go, if it falls to 1,700, don't exercise the option. Don't go and buy it from the person at 1,000 equal. Don't forget, you've entered into the contract. Let me check this. You've entered into the contract with a person fitting 1,800. So no matter what happens in the future, if I decide to exercise the price, it means that we are dealing with 1,800. Now, unfortunately, my speculation for the price to rise, that was my speculation. That's what makes it a long, because the buyer is speculating for a rise in the price. So I'm speculating that the price will rise in the future, right? But then, unfortunately, the future is not mine. It doesn't happen, and it falls to 1,007. So by means, if I exercise it, it means I'm buying it from you at 1,008. If I exercise, I'm buying at 1,008, and I'm going to sell it in the gold market at 1,007. I'm going to make a loss. So I'll say, since I have an option to buy or not, I will not exercise. And then the contract will end. But I've already compensated you for 50 in the future, right? So I'll still be okay. Why? Because if, let's say, I buy it from you at, if I go and buy it from the market at 1,007, right? I bought at 1,007 and I paid you 50 for the price of the option, so 1,750. And then comparing it with me buying from you at 1,008 plus the premium, I'm going to make a huge loss. So it's better I don't exercise the option and go and buy from the market. And you take the 50, at least take the 50. I'll still make some profits than me buying it from you at 1,008 plus the premium, making 1,850. And then I'm going to make a huge loss compared to 1,750. I hope it's quite clear. So if the price goes down instead of rising like I speculated, I will not exercise the option if I know I'm going to make huge loss. Okay, so if, let's say, the price rose to the price fell to 1,750. Let's put it 1,050, 1,007, right? 1,007. So let's make this. So if I decide not to exercise from you, it means I've already paid you 50. So my first cost is 50. I go and buy it from the market at 1,007. So now I have 1,750. 1,700. That's my total cost now. Okay, that's my total cost now. And now suppose that I bought it from you at 1,800. I bought at 2,800 plus my premium of 50 is 1,850. I'm going to sell it in the market at 1,007. Right, 1,007. I'm going to make a loss of 1,150, which is huge for me. You see, 150 compared to just losing 50, which is better. So you decide not to exercise at all. All right. And the last thing we look at on for today is the short call position. So we say we have the long call, just looking at the buyer's perspective. Okay, so the right to buy the asset. So selling a call option because you believe the asset price will not rise significantly. So if you are the seller position, right? So I am the so we entered into a contract, right? We entered into a contract that I went to buy a call option, right? And then I decided to sell the call option. If I'm selling the call option, it means that I'm giving, if let's say I'm the seller, I wrote a contract, a call option contract, right? That's the price. I want the price to be 10 because I think in the future the price will be 5. So I want the price to be 10. And I'm selling it. So if I buy, so from the buyer's perspective of the long call, when I bought the option and I paid 50. So the short call position is from the seller's point of view, but it's still a call position that gives the buyer the right to buy. So if the person sells the call position, he's selling it because he thinks the asset price will fall. Because if he saw the call position if let's say I saw the call position to you, it's in my mind, I have to honor the contract. If you buying it decide to exercise it, but then I'm taking those risks because I think the price will not rise, so I'm not going to lose. Not that I have the rights, because I'm the seller, I have the right to sell or not. No. The call option is the right to buy. Right? But in a contract, there are always two parties. Okay, so the person who wrote the call option. So when we're looking at the long, I said I went to the market and I went to see the contract and I picked. So I bought. Before I went to pick, so someone came to put there. So that someone is the person in the short call position. So the person who wrote the call option, that he wrote the contract that the price will be 10, the price will be 20 or whatever, and he put it down. Because he believes that anyone who buys it, right, anyone who picks it, if in the future his assumption comes to pass, and then the person exercises the right, he's not going to lose. That's why he believes the asset price will not rise significantly. Even if it's going to rise, it won't be huge, greater than the premium he's taking. Right, but he expects it to fall too. He expects it to fall, but even if it's going to rise, not going to rise that much, which will be greater than the premium he's taking. So let's not. So the short call, which is from the seller's position, the person doesn't have the right to sell or not. No, the call option gives the person holding it, who is the buyer and is in the long position, the right to exercise or not. And the seller has no choice but to honor it. If the person decides to exercise, you have to give it to the person. You have to sell it to the person. If the person decides to exercise. If the person decides not to exercise, then you are free to get it. But you don't have the option to sell it or not. No. Because the option you are dealing is call option, which gives the person holding the option, the person who wants the market to buy the option, the right to exercise or not. When the person exercises it, you who wrote the contract, you brought it to the market, have no choice but to sell it to the person. But you only take the risk when you think that the price in the future is not going to rise that significant or is going to fall. It's not going to rise above the premium that you are taking. I hope it's clear. Okay. So an example, we sell a call option for stock B with a strike price of 70, expiring in 3 months for a premium of 3. So the seller of the option, you can call the person the writer of the option. Right. So the person is like you go into the market, you want to go and buy. It was someone who brought it to it, okay. For someone who, so like you going to the market to buy the tomato, you have the option to buy it or not. So the person tells you, oh, sir, tomatoes, as the price of tomatoes has increased, it's now 5 cedi. You, the seller, have the right, you, the buyer, have the right to, you can say, okay, I'm buying it or I'm not buying it. You get it. So it's like that's another. So the seller is the one who brought the things wherever he brought it from and came to sit down there. So he's giving it to people. So the one who will decide to buy or exercise, he will give it to the person. So if you go and buy the tomato, say, okay, I'm buying the tomatoes at 50. The person said the price 50, right? But the person can say, okay, maybe other places the price of tomato is 10 cedi. But the person can say, fine, let me buy it from you now. So the person say, I'm buying it. You can't say you use the person, right? So you don't have the option, the decision. He has the decision. But you brought the things to the market, just assuming that the price will fall and then people will buy, or the price will not rise that much. I hope it's not confusing. Because call option, the right to buy, right? So whether the person is exercising it, you at the other end have to give to the person or not. Okay, so sell a call option for stock B with a strike price of 70 expiring payment. So the seller can also be known as the writer. So the person who sat down and wrote the option. Okay, so the strike price is 70, the expiration date to be 3 months, and then I'll take a premium of 3 cedis for taking up this risk. And the person will go and put it on the market, right? So if you come to the market and then you pick that option, that's you now be in the long position, right? Then you pay this person 3 cedis or $3 for the cost of the option, right? And so now I'm in the seller's position. You are in the right. So I'm in the short call position. So I will receive the $3, right, from you. You were in, if you are the buyer, you were in the long position. So when you come to me and you buy it from me at 3 cedis, you pay me 3 cedis. When you take the option, what I've written down, you pick it, you pay me 3 cedis. But mind you, I don't have the assets right now. It's just a contract with them. So in the future, when at the expiration date, then I'll get to the assets. So for now, I'm in the seller's perspective. So this is the income I receive from selling that option, from selling that contract. So if the stock stays below 70, option expires worthless. Why? The option holder will not exercise the option because it's not profitable to buy at 70 when the price is lower. So I'm selling and I'm taking the option, right? I'm selling the option and then the person paid me 50. So if let's say the price came to 60, right? 60, so I'm in the seller position. The price came to 60. You are in the buyer position, which is the long call, and I'm in the short call. But the call option gives you the right to exercise on it. And when you exercise, I have no choice but to obey the contract. Okay. Yes, not that I have a choice to say, oh, no. It's a call option. It gives only the holder or the buyer the right to exercise. When you exercise, I have no choice but to honor it. Okay. So if the price is 60, like we said earlier in the long call position, will you exercise it? No. Because if the price of the stock in the market is 60, would you come and buy it for me at 70? Would you come and buy it for me at 70? No. You won't buy it for me at 70 and go and sell it at 60. So you will not exercise the option because you make a loss, like I explained earlier. You will not buy it from me at 60 and then go and sell it. All other things being equal, provided you are forgetting about the premium stuff, you will not buy it from me because 60 cedis, if I buy it from, if the price in the market becomes 60 cedis or $60, and I'm coming to buy it from you at 70 and go and sell, no. So the option, the you who's the buyer will not exercise. So it means I will not be obligated to go and give you anything because you didn't exercise. So my profit will be the 3 cedi I got now. The 3 cedi I got, that will be my profit. Because you didn't exercise. So the 3 cedi, when you bought the option, the 3 cedi I got, you will not get it back. So I got my 3 cedi because you paid it upfront. Not expect me to give it to you back in 3 months time. No. So me in the seller position, my profit is just the 3 cedi premium. Because if the price falls, you are not going to buy. Do you get it? So it's like the short call is just to see the seller's position, like the one who is selling the call, what will happen to him if you, the buyer of the call, make a particular decision based on the price in the market. That's what I'm saying, that the seller of that call doesn't have the option or the choice to either do or not do. Whatever you do, he has to obey. Whatever you decide, he has to obey. So if you say I'm buying it, has no choice but to sell it to, even if it's not in his favor. So you're not buying it, then he keeps to himself, right? You not go and look for it in YouTube, but the 3 cedi he took at first is for him. So your profit will be the premium received since the option expired, because you from the buyer side will not exercise the option. Let's look at the last example. So write a call option on oil futures. So you see, let me check this info. In options, right? So we have the buyer can also be known as the holder. And then the seller can also be known as the writer. So as I was speaking, I was saying right and all that. So the seller can also be known as the writer. So the person who sat down and wrote the option and wrote all these contracts, made the contract and came to put it in the market, the person is the seller. Because he wants someone to come and pick it and it will work. If the buyer doesn't pick it and doesn't exercise and all that, it doesn't work. So the call option is the right to buy, and the buyer has the right, not the one who wrote who brought the contract to the market. No, the person who picked it up is the one who has the right to either exercise or not. So whatever decision that person who picked it up makes was what I will respond to. I don't have a choice to either respond or no, because the option is called option. So you write a call option on oil futures with a strike price of 85, expiring in 2 months for a premium of 5. So just like this one, you can try your hands on it. Pause the video and try your hands on it. So what would be the premium? So when the person writes it, your contract, and you want to put it on, it's like you the person who writes and will put it on the shelf in the supermarket. They put a price tag $5, right? So when I come and I pick that option, that contract, it's not an asset. I'm repeating it so that you not confuse yourself with it being an asset. No, the assets will get it at a later date in the future when the contract expires. That's when you will be exchanging the asset itself. But for now, we are just securing ourselves. So we are buying the contract and you pay 5 cedis. So I am in the seller's position with the short call. I'll receive the $5 or 5 cedis. And then the strike price is 85. So that's in the future. This is the price we're working with at 85 when we are exchanging the asset itself. So I will receive the $5 because you picked it up from the supermarket and you pay me $5. So from the seller's position, I'm receiving $5. If the oil price stays below 85, the same thing, the option will expire worthless, because since you picked it up, you have the right to either buy it or not. So if the price goes below, if the price is 70 in the market, so when we entered after 2 months or 2 months later, the price of the oil, right, in the market was 70, would you come and buy from me based on the strike price of 85? Will you come and buy from me at 85? No, unless you factor in the premium stuff, and then if you buy from me to be better. But if not, you will say you won't buy it from me, right? You go and buy from the market at the 70. You go and buy it on the market at the 70 cedis, and then you protect yourself, or you secure your position. Do you get it? Yes. So the option was par, because I can't come and force you to buy or no. I wrote it. I'm in the seller position. I only respond to what you do, because you have the right. Because the name of the option is call option, gives the buyer the right. So it gives the holder the right to buy or not. So the person who pick the call gives you the right to buy the asset from me in 2 months' time or not. So if you decide to buy from me, they have to respond and go and look for the asset and sell to you at the price we agreed, no matter whether I'm making a profit or loss. You get it. But if you don't exercise, then that's fine. But I've already paid my $5, and that's what I am working with. So that will be my profits. Okay. So yeah, that will be my profits. So I hope this so this is a try week. You buy call option on a tech stock at $100, expiring in 6 months for a premium of 10. If the stock price rises to 120, exercise the option, calculate the net profits. If the price rises to 120, so in this, you are looking at the long call position and then the short call position. You will pick that option on the market. So you pick it on the shelf, from the shelf, and you pay 100 from it. You are in the long position, because you pick it because you expect the price of the stock in the real market to increase, so that in the future you can go and buy it from me. You buy that stock from me at a lower price and go and sell it and make profit. That's why you picked. So you are in a long position. You're expecting price to rise. You are looking at the future rise of the price. So what you would do will determine how I'll respond. So if you were in that option, which gives you the right to buy from me, if you decide to buy from me, then I have to go to the market and go in for the stock and come and sell to you at the price we agreed. Doesn't matter whether I make profit or loss, because the focus is on me. It's on you who is the buyer. Now come and give it to you at the 100. I'll give it to you at the 100, because that's the agreed price, not the 120 in the market, because that's not what we agree. So I give it to you at 100, and me, I'll go to the market, go look for a normal investor, sell it to him at 120. I'll make a profit before factoring in the premium and all that, which is looked at. Okay. So with this topic, you have to be looking for examples, more examples to try your hand on. I think it's for sure. So I think we'll end here for today. And then at that time, look at the put option, which is the opposite of the call option. We'll try to process this information and draw a table to make it clear, so that when we do the put option, it won't be confusing for you. Okay. So I think, yes. Anyway, so thank you so much for watching this video. It was a pleasure, and I pray that God helps you to understand it very well. So we meet again. It's a goodbye for now. Bye.